I'm Taylor Riggs in San Francisco in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, a strong showing. Netflix reports solid fourth quarter as it sees a 20% subscriber boost, but the company says that kind of growth will fall short next quarter. We'll look at every angle. Plus, IBM beats the computer and IT giant ekes out revenue growth thanks to its cloud. We'll break down the numbers and discuss how the company is positioned for the rest of 2020. And speaking of the cloud, Microsoft CEO Satya Nadella sat down with Bloomberg in Davos. We'll hear his thoughts on the stiff cloud competition between Microsoft, Amazon, and Google. But first, to our top story. Netflix shares initially jumped post-market before erasing those gains after reporting fourth quarter earnings, now fluctuating between gains and losses. The company says it's hit a milestone, surpassing 100 million paid subscribers outside the U.S. during the quarter. However, it does see growth slowing a bit next quarter and forecasts just 7 million subscriber additions in Q1. To discuss the earnings report in further detail, we're joined by eMarketer's Eric Hagstrom. Also with us, True Optics CEO Andre Swanston. Thank you both for joining me. Eric, let me start with you. Really seems like the shares were trading off of the first quarter subscriber guidance, which came in a bit light. Are you worried at all now that further competition is slowing down growth for Netflix?
No, not at all. Netflix is pretty, they're pretty strong in the developed markets already, so there's not a whole lot of growth specifically for them in the US. Looking abroad, they have a lot of room to grow, but that growth is going to be difficult. When you talk about that 7 million subscriber guidance, it's actually compared to pretty strong Q1 in 2019. So when you look at the year-over-year comparisons, it's a very strong or weak comparison compared to last year.
Andre, let me get your thoughts on this, because typically they've been a little bit conservative when they forecast some of their guidance. Do you feel Netflix is being conservative, or is there a real potential slowdown underway?
I've long said, I think, probably almost a year now, that the real competition for Netflix really starts in 2020. And I still believe that to be so. And so if I were them, I also would be conservative, because I do think that it's going to be difficult to tell what the full impact of all these other new solutions will truly be on Netflix in the first quarter. And second quarter, probably even more so than Q1.
Eric, I want to come quickly, I'm doing this in real time, and take a look at a chart here that I'm showing inside my terminal, because you mentioned how the U.S. domestic market is a very mature market. Mm-hmm. And you can see, of course, in the fourth quarter, it was that U.S. market that has struggled. Is that normal, like you said, given it's a mature market, or would you like to see more U.S. subscribers really coming online?
Well, again, subscriber growth in the U.S. is going to be lumpy moving forward. And that's largely because they're already reaching well over 50% of all U.S. households. Now, there is more growth for them, but when you consider that more people watch Netflix than actually subscribe because of, obviously household sharing, but also password sharing with people outside their household, there's not a whole lot of room for them to grow anymore within the U.S. in terms of subscribers. But they still offer a great value to consumers, and they can continue to raise prices moving forward.
Andre, I want to get your thoughts a little bit more on that competition that you were talking about. I so often hear that domestic user is a much more valuable customer because they're more profitable. I know that the growth is internationally because it's less of a mature market, but that customer over there isn't as profitable. It's not as valuable. How do you view the mix between both domestic subscribers and the international subscribers as well?
Yeah, so I think the domestic subscriber is actually much more important in terms of, especially over the next year. And I would disagree with what the common thought is from a lot, that Netflix can increase revenue by just increasing the price. Netflix is now actually priced at a premium compared to their competitors, with Comcast announcing Peacock having a free tier, with the Disney Plus coming in at a cheaper price, and there's Pluto TV and others that are now free streaming online. So the real challenge for Netflix is going to be, I don't even think it's going to be client growth. I think retention of clients is going to be much more of a difficult thing domestically than I think people are giving it credit for, because there's so much more free solutions that are coming on and cheaper price solutions. More content is being pulled from Netflix, and I just don't think they can spend their way out of it like they have in the past.
So, Andre, I want to get additional thoughts from you because Netflix itself did come out and say that customers are leaving due to recent price increases. What level of churn and price increases are you really comfortable with?
It's difficult to say what the level of churn is. I can say that I'm not comfortable with any additional price increase from Netflix. I just don't think it's feasible. So what Netflix benefited from tremendously was first mover advantage. You know, if you think about it 2 years ago, having a Netflix, if you had connected TV or any sort of streaming device was almost like a utility. It was pointless to have these devices if you didn't have Netflix a few years ago. Now you have people that you don't need Netflix. A lot of the most popular content from that is licensed is coming back to the original owners or going to other platforms. There's half a dozen cheaper options that have significant content. There's solutions like Pluto TV and Zumo and then Peacock that are 100% free that still have a lot of content, IMB TV from Amazon. And so I just don't think it's realistic for Netflix to increase prices even a penny. I would argue that to have success in 2020, they're really going to have to diversify their business model and have a cheaper ad-supported tier or make some acquisitions or do something.
So, Eric, do you also think that they should create more of a tiered subscription and come up with a lower priced ad-supported model? A lot of analysts say they're missing out on $1 billion a year by not having ads.
Well, I think introducing a lower cost ad-supported tier is a great idea, specifically in order to reduce churn on the low end. But at the same time, ads will never be a major driver for revenue for Netflix, largely because this is a service that would be, or a low end, ad-supported tier would largely be just there to keep people on the service and keep people within the ecosystem. When you look at competition from all these other ad-supported options, like a Zumo, like a Hulu, people spend a lot less time watching those. And when Netflix has constantly talked about retention, it's driving time spent. So when you introduce ads, time spent will drop specifically for those users. So it's important for Netflix to continue to just do what they're doing, produce content that people want to watch, and produce value for their customers.
Andre, I want to bring you back in here and come and take a look at a chart here that I'm showing inside my terminal, which is the story that we know, and that is how capital intensive this business is. The free cash flow now in the fourth quarter coming in at $1.5 billion. Netflix has said 2019 is a peak deficit year for free cash flow. Does that give you any optimism?
There's also been reports that they're going to spend almost $20 billion on content. They've spent so much money already. What the street has given Netflix credit before was for the massive growth that they were seeing. If growth slows and competition rises, I don't think they'll be able to, as I said before, spend their way out of it. The other concern that I would have is that all this spending is a pretty old strategy in terms of just becoming more of a traditional media company, spend more on content. They haven't done things like some of the other major media companies or technology companies have in terms of diversifying into, say, streaming video game playing or other areas. And so where I look at their spending, it's not so much the dollar amount, but it's the lack of diversity in terms of the way that they're leveraging that capital. That's really the concern as I look at it.
Eric, as we talk about the diversity, leveraging some of that capital, you hear kind of one-off random rumors of would they buy a movie studio? Sort of how can they sort of enhance a vertical or a horizontal supply chain, if you will? Is that totally out of the question? Where would you want to see Netflix go forward in 2020?
Well, I can't imagine them buying a large movie studio simply because they already are a large movie studio. They have a lot of content that they've produced in-house that they also own now, and that's only going to continue to increase as a share of their total library content. And also talking about things like diversity of revenue, looking into other areas, they're competing against a ton of different companies that have large, diverse revenue streams like Disney, like Amazon, Apple. But again, Netflix is hyper-focused on making this work, and it's a pretty big sandbox for them to play in. When you look at how much people spend on traditional pay TV, as well as other media forms like the movie theaters and things of that nature.
Eric, finally here, $14.8 billion in long-term debt. That's up from $10.4 billion a year ago. Are you worried about the health of the balance sheet, or you like that they're borrowing to keep that cash on hand?
Well, interest rates are low right now, and hopefully they will stay low in order for Netflix to continue. But their biggest strength right now is scale, and they're still growing by quite a bit, especially abroad. So with that scale, that debt, that balance sheet does get spread out over more customers. When you look at something like a Disney or an Apple, they're spending all that money on a very small number right now, and they're hoping for that to grow. Netflix is already there. They already have achieved large scale.
Well, I think like both of you gentlemen have said, the question of spending to keep off competition is a story that we will continue to discuss. Eric Hagstrom, of eMarketer, and True Optics CEO Andre Swanston, thank you both for joining. Now, Lyft is teaming up with NBA All-Star LeBron James to give away free bike share memberships for thousands across the country. This is part of a new, larger initiative to expand transportation access to communities in need called Lyft Up. Lyft Up will partner with leading nonprofits to provide free and discounted rides for our programs, including grocery jobs and voting access. And later in this hour, we will bring you our conversation with Lyft co-founder John Zimmer on that announcement. And coming up, IBM posts a revenue growth surprise, breaking 5 consecutive quarters of declines. We'll find out what's pushing the company back into top-line growth. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. IBM posted fourth quarter earnings Tuesday that beat analyst estimates on revenue growth and broke 5 consecutive quarters of declines. IBM's push into the hybrid cloud market appears to be paying off. With more, I'm joined over the phone by CFRA market research firm equity analyst David Holt. David, finally a return to growth, albeit small, only 0.1%, but frankly, investors probably are pleased. What's driving that growth?
Yeah, sure. So first of all, thanks for having me. With the FX impacts, those were slightly smaller. I expected about 60 basis points versus about 100. Divested businesses were in line with the expectations of around 200 basis points. But really, when you look beneath and kind of dig a little deeper, cloud and cognitive was towards the higher end of expectations of around 9%. High single-digit growth was expected, but surprisingly, transaction process platforms actually grew, even bumping up against some tough comps from the year prior. On top of that, you did have the Z15 mainframe ramp, which actually grew about 16% as a whole with the segment itself, and IBM Z, which is the mainframe, grew about 60% too.
And David, I want to dive down into the different sectors of the business. But first, as you look forward to 2020, do you believe the promises of a sustained return to revenue growth and margin expansion?
So I think a lot of it comes down to a stronger dollar. And when you kind of look at this on a constant currency basis, if those currency headwinds do abate in the second half, especially with some of the contribution that you're getting from Red Hat, which on a normalized basis is growing mid-20s as of this quarter, and it's accelerating, scaling through some of their own services segments, which is about 60% of the revenue. So that right there is probably the key component to revenue growth on a constant currency and continual basis into 2020.
I want to talk more about that cloud revenue growth. Where do they stand relative to competitors? You mentioned they purchased the Red Hat acquisition in around 2018. They spent $34 billion on it. Where does that now position them among the other competitors in this hybrid cloud strategy?
I think this puts them more in a middle layer opportunity, especially when you're considering linking towards some of their consulting divisions with GBS or Global Business Services. It definitely does not put them, face to face with some of the other bigger competitors in the space when you mentioned Google or Amazon, but more so that niche play and some of the workflows that actually can be scaled through to their services, which is a value add and hopefully drives growth and margin expansion for 2020.
David, reading through some of your research notes, it was interesting that they've said that they'll keep the Red Hat acquisition and some of the operations independent, not really fully integrated with the whole of IBM. In your opinion, is that the right strategy?
I think it is. Kind of compartmentalizing Red Hat and keeping that separated. it definitely helps kind of assemble the right arrows in the quiver for IBM, but at the same time doesn't make Red Hat kind of change up their strategy, which has been working well with at least mid-teen growth prior to the acquisition itself. But what you're, again, actually seeing is that growth accelerating and the contribution that you're getting from Red Hat on a normalized basis actually helping and giving a boost to cognitive, which is overall good for IBM.
You know, David, I have you on the phone, but I want to come and take a look at a chart here that I'm showing for our Bloomberg viewers here, which you know the story really going back since early 2012. IBM still down about 3% relative to Amazon, Microsoft, the NASDAQ broader index, which are up anywhere from 200 to 1,000% over the last 6 years or so. Yet you have a buy rating. Is it purely a valuation standpoint, given the recent underperformance of this company?
I don't think it's specifically valuation specific, but when you look at kind of what happened in 2019 and the banner year that we had, and some of the multiple expansion that's occurred, that's 80% of kind of the market performance that we've had. Unfortunately, IBM didn't fully participate in that rally in 2019. But when you kind of shift over and see the melt up that's occurred in 2020 as well, I think it leaves us much more susceptible to some bad news, as we've kind of seen today. If that happens, and kind of when you look at IBM, there are catalysts that are hopefully in play, especially when you look to 2020. And it all depends on kind of what happens and what's said on the call today. But when you look at it from a total return perspective on a capital return and a dividend yield basis, it's a pretty intriguing play, especially when you're just looking at the full, I guess, investment thesis as a whole.
Yeah, a wonderful analysis on the money there. Thank you to David Holt of CFRA. And we will hear from IBM CEO Ginny Rometty Friday from Davos. She will lead a panel on artificial intelligence. IBM has called for certain rules aimed at eliminating bias in AI. The company is trying to ease concerns that the technology relies on data that bakes in past discriminatory practices. Many companies are looking for consensus on industry rules rather than wait for government regulation. And up next, talking trade, Bloomberg sits down with Cisco CEO Chuck Robbins at the World Economic Forum in Davos, how evolving trade relations have affected Cisco's business in China. Stick around. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Prior to the Phase 1 trade deal between the U.S. and China, Cisco saw its China business struggle. Its sales fell, and the country's state-owned enterprises were no longer taking bids from Cisco. Now, after the trade deal signing, the company is working to gain a firmer foothold there. CEO Chuck Robbins sat down to discuss with Bloomberg's Jonathan Farrow at the World Economic Forum in Davos. Take a listen.
Ultimately, the need to have global communication standards will take over, and we'll figure out ways to deal with multi-vendor systems, and we'll figure it out. I think that there's discussions going on right now in Washington around how do we make sure we're engaging on standards. So I think everybody realizes that this is a really important thing for us to get right. No one wants us to get to a balkanized situation. I mean, at least most of us don't want that to happen.
Sure.
So I really don't believe we'll get there.
So you're not conceding that as a U.S. company, your chances of getting big in a place like China are pretty remote?
Well, they're two independent issues, right? So,
well, let's talk about both of them.
So the standards issue is just to ensure that we can pass traffic, right? Which is that's foundational. And then obviously what happens in China is up to the Chinese. And so they, we've worked hard for years over there to build up trust. We've been there for, 30 years. And, this situation that we have right now has created some short-term confusion, short-term challenges. And my hope is that once we get past it, that we'll begin to accelerate our business in China. We'll find a way to do business there, but we'll have to see.
Clear tensions between the United States and Chinese over the last 18 months, many more years before that as well. But at the moment, we finally have a Phase 1 agreement. Let's call it a truce. Something has been weighing on Cisco stock over the last 6 months is not a secret. It's business spending.
Yeah.
Have things changed for the better? What are you seeing in the business right now?
Well, if you think about what's happened over the last 6 months, the activity with our customers hasn't declined. And our customers today understand that the technology we build and the other companies build, it's core to their strategy moving forward. It doesn't enable their business, it is the business. I mean, everything that they do is dependent upon technology now. So we still see the same level of activity. We're engaged in the same number of opportunities. It's just that we saw a little bit of a pause because I think of the uncertainty around what happens with China, to a lesser extent USMCA, which we also have resolved, to some extent, Brexit, which we soon will have resolved. So actually, I believe that if we can begin to just get more clarity in the system, the markets and business don't like uncertainty.
Well, what's morale like at the moment? For you in the C-suite, it was a masterclass in execution, getting ready for the tariffs and getting ready to adjust the supply chain, bang, done. Yeah. And then you get hit around the head by the macro issues. How do you cope with that?
Well, you can't do a lot about it. So you just have to continue innovating, continue doing the things you do.
Yeah.
Be prepared, be ready with your customers. And but again, this hasn't been a massive, significant fall off. It was just what I call is just a shallow pause where we see customers. If you're buying capital equipment, it's easy to say, let's just wait another month or two, or let's get another set of eyes on it. The good news for us is we've made huge progress on our software transition. 30% of our product business is now coming from software. The tough part in this kind of environment is 70% still hardware.
That was Cisco CEO Chuck Robbins. And coming up, Netflix expects to add fewer subscribers in the first quarter than Wall Street estimated, renewing fears that new streaming competition is hurting growth. We'll get investor insight on Netflix next. This is Bloomberg.
There is no truth in the allegation that the central government is tightening its grip on Hong Kong. The central government has time and again made it very clear that they want Hong Kong to succeed under one country, two systems.
This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Taylor Riggs in San Francisco with Sherry On in New York and Heidi Stroud-Watts in Sydney. Let's take a look at those top global tech stories of the day. Sherry.
Taylor, Huawei CEO and founder Ren Zhengfei is shrugging off the threat of the U.S. imposing even stricter sanctions against its company. Speaking during a panel discussion at the World Economic Forum in Davos, Ren said he was confident Huawei can survive further attacks from Washington and that the impact on business would not be very significant. Apple is planning a move into original podcasting. People familiar with the plans tell Bloomberg that Apple is in discussions to make original podcasts related to programs on its Apple TV Plus video streaming service. Apple sent out a request for pitches last summer, asking podcast producers to pitch ideas for audio programs with some connection to its shows. Vodafone has left Facebook's Libra cryptocurrency project. The UK telecom giant said it wants to focus on its own digital payments efforts instead. The Libra Association is now down to 20 members from an expected 28 when it was launched in June. Those are the top global tech stories we're watching. Taylor?
Thank you, Sherry. Now, Netflix shares fell but have since recovered in after-hours trading. The streaming service expects to add fewer subscribers this quarter than analysts had expected. For a reaction on the Netflix numbers, let's bring in Dan Morgan, Senior Portfolio Manager at Synovus Trust, which owns shares of Netflix. Dan joins us from Atlanta. Dan, I want to come and show you a chart here that I'm showing inside my terminal here, and it is the story that you rightly are pointing out as well, and it is the slowing rate of growth for these U.S. domestic subscribers. How worried are you about domestic subscriber growth that's slowing?
Well, you're right, Taylor. I mean, it was really interesting because on this fourth quarter, they only did a little over 400,000 domestic subscribers, which was a 72% drop from the fourth quarter of last year. And yet they were still able to ink out some growth in terms of revenues. They were up about 23% in terms of domestic subscribers. So it really looks to me, Taylor, like they're countering the drop-off in domestic subscribers with these price increases, right? So they're getting more revenue per total subscriber, which is allowing the overall domestic revenue to go up. But you're still seeing a huge drop-off, like you mentioned, 400,000 roughly domestic subscribers of what, 8.7 million total subscribers on the fourth quarter. So it's a very small piece of their overall growth.
Dan, is this really the competition from Disney, from Apple TV that's starting to bite here?
It really looks like it is. I mean, if you were a bear on Netflix and you were concerned about competition, when you look at that subscriber number on the domestic side, you'd have to say that obviously they are starting to feel some sort of negative impact because there was such a drop-off, 72% in year-over-year subscribers on the domestic front. And, you know, we look at these other services. Obviously, this will be the first quarter. This fourth quarter was the first quarter that we saw Disney Plus was fully on. We know that Apple TV came out with their introduction. And, you know, these are much lower cost per month services. Disney Plus is what, $6.99 a month, and Apple is what, $4.99 a month, something around that level. And you compare that to Netflix, its averages what, $15 to $20 a month, depending on the plan that you're in. So domestically, it does look like some of these competitive forces are starting to impact that overall subscriber growth.
And Dan, it wasn't just competitor forces, but also the price increases that you mentioned, and Netflix responding to that and coming out and saying, yes, customers are leaving due to recent price increases. What level of churn here are you comfortable with to remain a buyer?
Well, I think, Taylor, the question, we're zeroing in on that domestic front, and really the growth component for them is the international space. That did very strong on the quarter. They did over, 8.3 million new subscribers. So I think the challenge going for them forward is how can they maximize the subscribers internationally, and how can they keep it growing? So we don't have a huge position, Taylor, in Netflix stock. It's not one of our major tech positions. We have a kind of a minor position. But I think for viewers out there that are looking at the shares, I think you're going to continue to have a bit of a black cloud going into upcoming quarters because of these concerns that we're talking about today in terms of competition.
Yeah, and it's interesting because they've always said that their strategy is full steam ahead, they're on course, and that regardless of the new competition, that doesn't change their tactic, right? Does that sort of still ring true to you?
Yeah, I think so. I mean, they're spending, what, $19 billion a year in content. And their goal is to hook as many people as they can into these series that they come out and produce. So, again, it's kind of like a pedal to the metal strategy. As you mentioned, they have free cash flow burn of anywhere from $2.5 to $3.5 billion. So it's almost like Jeff Bezos at Amazon, kind of a similar strategy that he was using, where they're just trying to get as many subscribers as they can. So, I mean, so far it's worked. I mean, they had a good number. They beat estimates. It was just that subscriber growth number estimate for the upcoming first quarter of 2020 obviously was a huge miss. So maybe they're just giving us a lowball number that they're going to beat down the road. We'll just have to see.
Dan, you mentioned free cash flow burn, and my ears start perking up. So I want to come and take a look at a chart here inside my terminal, which shows that free cash flow burn. Netflix coming out in the earnings results and saying, don't worry, 2019 was a peak deficit year for negative free cash flow. Do you believe that?
Well, I mean, the estimates going into next year are a little bit less than this year. But as I mentioned, that obligation they have to continue to add content is very sizable. It's kind of a catch-22 because they continue to add debt. I think they closed out this year at about $14 billion. They added about $3 or $4 billion in additional debt. So, that is a challenge going forward for them. Negative free cash flow leads to the issuance of more debt. which puts pressure on your operating margins, right? Because you have to pay interest expense associated with issuing debt. So that is a challenge for them. As you've probably talked about, their bonds are not investment grade. They're kind of a double B type of territory, so they are considered junk bonds. So that is a challenge going forward for them, this vicious cycle of, content, free cash flow burn, and debt. Where does this lead us at the end? We'll just have to see.
Are you comfortable with the 12% increase in marketing spend?
Dan, oh, you know what, Heidi? It looks like we lost Dan. Heidi, it's so interesting. I'm going to let the producers get back and bring Dan back online. But Heidi, let's talk about that question a little bit more, because it's so interesting when you talk about the increase in marketing expenses. You and I have talked a lot about this, about all of that competition coming online. They've increased their debt load, as Dan was mentioning, to $14.8 billion from $10.4 billion. So not only are they increasing debt and spending that free cash flow, but like you said, those marketing expenses rising 12%. I think that'll be very interesting to see if analysts indeed are comfortable with that number.
Yeah, and I suppose the sustainability of that spend going forward, right, as we were talking about, or as Dan mentioned earlier, they've got the cash to burn, but to what end? And I suppose what are they getting for how much they're pushing out the marketing to be able to highlight the new content as well? Something else that I thought was interesting that we highlighted in our T-Live blog as we were covering these earnings details coming out is how Netflix, of course, recently changed the way that they even measure viewership, right, Taylor? So it used to be a viewer had to watch 70% of a show to be counted, and now they just have to watch 2 minutes. I'm wondering, you're counting all these people, probably me included, at home, who is just kind of flicking through and watching the first couple of minutes and then changing their minds and then doing something else, right? Whether that's kind of, I guess, an accurate way of measuring that metric.
Yeah, a lot of different reporting requirements, if you will, that are coming out. Thank you there to Heidi, my colleague, and also thank you to Dan Morgan of Synovus Trust. And stay with us, because we do have much more ahead. This is Bloomberg. There's a truce in the dispute between the U.S. and France on digital taxes. A French diplomat says that means neither President Trump nor President Macron will impose punitive tariffs this year. The battle was over a French tax that hit American internet giants such as Google, Apple, and Amazon. And another tech giant, Microsoft CEO Satya Nadella, sat down with Bloomberg News editor-in-chief John Micklethwait at the World Economic Forum in Davos Tuesday. He explained why the tech giant has decided on the $1 billion commitment to be carbon negative by 2030. Nadella also addressed Microsoft's cloud competition with Amazon and Google.
It came down to saying, look, what is Microsoft's responsibility? We are increasingly becoming a big consumer of energy because of what we're doing with the cloud. And it sort of, was very clear to us that given the science that climate change requires immediate action, this is the decade. And so we wanted to start by saying, look, let's make some good commitments. And the commitment to being carbon negative by 2030 means we will now have to make sure that all of our data center operations are first consuming renewable energy. And then also we take all the carbon that we have put out and ensure that by, either through new technology or by natural means, we can take it out and become carbon negative.
And that, as I understand it, that is all the historical carbon you think.
And that'll be by 2050. So we want to go back to all the way to 1975 when we were founded, and we take out all the historical carbon as well. And that's the other commitment. And when it comes to the, $1 billion fund, we do need real breakthroughs. This is no one company is going to do this, and so therefore we are very committed to sort of putting even our own balance sheet money on it, and then looking to see the ecosystem.
You were in the news a bit because there's been, as you know, backlash about Narendra Modi's Citizen Amendment Act, which some people think sort of discriminates a bit against Muslims. You made some critical noises, but you also pointed out that this is not the job of CEOs, it's the job of governments to do these things. But do you worry? I mean, you're from India originally. Do you worry about what's happening there?
First of all, I'm an India optimist. When I think about, the multicultural ethos of the country, the vibrant democracy, and the economic opportunity the country has to raise what is 1/5 of the world's population and participate in the fourth industrial revolution, I'm an optimist. And I think in order for India to stay on track on it, I think it has to manage all of the challenges. And that social ethos that has made the country what it is, it's going to celebrate its 70th year as a republic soon. So that's what...
But its republic, as you know, which was founded on the idea of tolerance, and most people would say this does not exactly bespeak tolerance.
I think the fact that there is that 70-year history of nation building, I think it's a very strong foundation. So I grew up in that country. I'm proud of that heritage. I'm influenced by that experience as well as my immigrant experience in the United States. And so therefore, I remain an optimist. And I think that what is happening in India today it'll hopefully build on that multicultural ethos that that country has.
You mentioned quickly the immigrant in America. And again, Microsoft is one of those companies that's pushed quite hard against the sort of current flavour of, I suppose, immigrant bashing. Do you think that that is being changed in America?
I think, first of all, America is a country of immigrants. It's a nation formed by immigrants. And to me, when I look at the contribution that immigrants even going forward can make is something that I think the United States should be absolutely tapping into. And so that is what I speak to, and that's what I think the Microsoft has benefited from it. I personally have benefited from it. So we're clear in terms of why immigration and enlightened immigration policy continuing in the United States is perhaps one of the most important things for its own competitive advantage.
Do you worry that it's now getting slightly unenlightened?
Not really. I mean, I think still America is the place where people want to come to. One of the things that's happening is every country is rethinking what is in their national interests. Borders are real. People think about immigration policies that help. But I think in there, they have to maintain that modicum of enlightenment and not think about it very narrowly. And that's what has, I think, made it possible for those values that have helped people come be the attractor. It's not about, people only will come when people know that you're an immigrant-friendly country.
Do you think the number coming from the cloud side is going to continue to grow as a proportion?
Yeah, I mean, if you think about it, right, 5% of the world's GDP is tech.
Yeah.
That's going to double by 2030 to 10%. And so if you think about being in the cloud business, and especially being in the cloud business across all these layers, means you get to participate in it. But the real thing is, it's not about the 10% of the tech spend. What about the other 90% of the GDP? To me, what is of deep interest is to see that broad sectoral productivity growth really shape up because of digital technology and the contributions we make.
And one thing on that, you are still behind Amazon on that. How do you close that gap? And are you worried at all about Google?
I mean, look, we're going to have we have had competition in the past, in the previous era, and this era we have new competitors, and we feel very, very good about our position. If you think about, 5 years ago is when we started talking about hybrid cloud and the edge, and today it's now the conventional wisdom. So I feel like we even, if anything, have an architectural advantage in terms of what the next innings of the cloud is, and that's what you see play out in the marketplace.
Architectural advantage, particularly over those two companies, over Amazon and Google?
Yeah, because we built effectively a distributed computing fabric, recognizing that computation is going to be more distributed than it's not just the cloud, it's the cloud plus edge. And so with something like 5G, you see that play out in a big way.
That was Microsoft CEO Satya Nadella. And still ahead, NBA star LeBron James as Lyft's latest partner. We'll find out what they're planning next. This is Bloomberg. On Tuesday, General Motors Cruise startup will show its first vehicle designed to operate without a driver. Bloomberg has learned the car lacks traditional controls like pedals and a steering wheel. That will free up room for commuters who would share rides. And ride-hailer Lyft is turning to one of the NBA's most famous players to boost a new service. LeBron James is on board to help promote Lyft Up to expand access to bike sharing across the United States. The plan sees young people being offered free one-year bike share membership for Lyft systems. Bloomberg's Jason Kelly spoke to Lyft co-founder John Zimmer about the program. Take a listen.
We just launched a bike access initiative with LeBron James giving bike memberships on City Bike, which is a Lyft-operated and owned system, to thousands of kids across New York, 16 to 18-year-olds, making sure that they can get where they want to go, whether that's school, a job in the summer, or really wherever they want to go. And it's all part of a broader effort called Lyft Up, which is our initiative to make transportation more accessible to everyone.
And so how does this partnership come about? How did it come about with LeBron specifically?
So LeBron's manager, Maverick Carter, and I have known each other from probably the beginning of Lyft. And he was one of the first people that really believed in me and what we were doing. So we've been talking for many years, and we wanted to work together. And we wanted to be truly authentic to who he was, who Uninterrupted his company is, and who LeBron is. And he told me the story about how important the bike had been for him and LeBron when they were growing up to get them to practice. And so the idea was, now that we run the largest bike share program in North America, let's make that accessible to those that don't have access to transportation.
So what are you learning when it comes to bikes in terms of the complication, especially as it relates to the rest of your platforms?
Yeah, so each mode you have to invest in and go really, really deep. So with bikes and scooters, you have to get up to a certain scale. You have to get really good at making sure there's bikes where people need them, that they're charged if they're electric bikes, and when you're dealing with hardware and making sure it's available at all corners of a city, obviously that's different, but there's a lot of relation to rideshare, because we have to make sure our drivers are well positioned throughout a city for when the demand comes. So mapping demand and the supply, whether that's a rideshare vehicle or a bike, there are actually quite a bit of similarities.
All right, so if I have you here, I got to ask you a little bit about cars, and obviously a bike takes a human to very much be invested and paying attention as he or she is driving on two wheels. What's the future of autonomous driving at this point, based on what you guys are seeing across your business?
Yeah, so over the next few years, we already have in markets like Las Vegas and Arizona some of our self-driving partners live with Aptiv and Waymo. And I see it growing out as a small percent of our rides to maybe something like 10% of our rides, and then 20%. It's not something that overnight autonomous cars do everything, but I do believe autonomous will be launched on a ride-sharing network like Lyft, because we have all these other modes of transportation and other ways to get around for an autonomous vehicle that can only do select things.
All right, so John, I want to ask you a little bit of a political question here. A lot going on back in California as it relates to how you and Uber deal with the gig economy, all those sorts of regulations. What do you make of this idea, this announcement today, that Uber might let some drivers set their own fares? Is that something you're looking into as well?
I'm not going to comment on any specific features that we may work on at some point, but I can tell you that I think what's happening in California is a big opportunity to think about how to combine the benefits of this new type of work with benefits that workers deserve, and so we're navigating that and excited about the next year ahead.
All right, so one last question about bikes. You did this deal with LeBron. Are there more? Not that there's anybody exactly like LeBron, but do you expect to do more deals like this to further expand the bike share business?
Yeah, bike share is just at the beginning. So, we're now in 8 cities across the country with programs like City Bike, which is what we have here in New York, the program for Lyft Up to bring access to others. We're doing grocery access. We're doing jobs access to get people to job interviews. And today we launched bikes access with LeBron. We hope to do more like this, but, it's really important to us that it's authentic. And that's why we decided to work with LeBron and Uninterrupted, because it is authentic to what he wants to do, who he is, and what helped him get to where he got.
That was Lyft president and co-founder John Zimmer. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. And be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.
In the top 30 markets in the U.S., we're the top market share in retail banking, 12 of them. The nearest, I think, is 6 next to us. But the reality is, up until 2 years ago, we weren't in 7 of them. So if we just fill out those 7 to be like the other markets, that's a lot of growth, and we can do that all over the U.S.